Honestly, Scott, I'm feeling like we're finally ticking the boxes of earnings falling apart. And we've been waiting for this to happen. I keep saying this over and over again. There's usually a sequence of events. First, the market goes, then earnings go, then the economy goes. So I think this is finally that part where we're seeing earnings get hit. And I don't think it's any mistake that it's tech that's getting hit the most. Tech is what has been under pressure in this market since the beginning. And it was the first thing to be under pressure. If we remember way back to that first time when the Fed retired the word transitory, tech fell out of bed and continued to go. So they're the first earnings that are really getting hammered. I think that this is just another check on the list of things that we need to get through before we can really be done with this part of the cycle.
So you truly think this is a dramatic moment that we are going to mark in time? They will timestamp this as a shift for these companies as the tried and true investments that they have been for the last many, many years?
Well, I don't know that I would say they're companies that we're going to run away from as investments, but I would say also I'd echo, I think, something that Steph said earlier in the show. Valuations matter a lot right now. They matter almost more than a lot of other fundamental metrics in this environment, especially in an environment where we have a Fed meeting coming next week, another one in December. So looking at how much people are willing to pay for, number one, that future growth, and the future growth isn't looking great. A number of these companies have missed on revenue in a time when inflation has been sort of buoying revenue. So future growth isn't looking great. They're not controlling costs to a point that is satisfying investors, and now the earnings and margins are going to get hit. So I think we'll mark this moment in time as this is the beginning of when the market realized earnings were actually going to be pressured, and when we realized that 2023 earnings might end up a contraction year over year versus 2022.
Did we collectively stay, and we, by I mean investors, did we stay too long? Did we stay at the party too long with these stocks?
With tech stocks, you mean the mega cap tech?
Yeah.
I mean, I think some people did, but look, all of us probably did. And by no fault of our own, we're also still invested in many of these if you're a broad index investor. So if you have any ETFs in your portfolio that invest in a broad index, we're still in it. So did we stay too long in the sense of should we have run for the hills sooner? I think a decent amount of people did. And I think starting at the end of last year, people really did. So that was an important move to make. Now, did we hope that they would be the ones that would still stand up in the face of pressure like they did the last time? Yes, I think that's maybe where investors have gone wrong. We're really comfortable with these big cap tech names. We use them in our daily lives. We've been invested in them for a long time, and they haven't really led us astray. So I think there's probably a little bit of overconfidence on behalf of the investing public at large. But these aren't names that I think are going to disappear in this cycle. I think that they'll come back eventually. It's just that for this next 3 to 6 months, it's going to be really a tough slog for them.
Yeah. I appreciate it, Liz. Thank you so much. That's Liz Young of SoFi joining us.